Alright, good afternoon guys. This video is adapted from the November 2016 paper. I'm doing ratios again, asset test, debt equity, ROSH, net asset value per share, and I'm going to answer this 4.2.5 and 4.2.6 for you so that you have an idea how to basically answer these questions. Let's get into the swing of things. So asset test ratio, straight away, like I said, I will just show you the formula. Current assets minus inventory is the current liabilities. It determines whether the ability of the business to pay off its debts. Too low, they will not be able to meet its obligations. Too high, it mustn't be too low or too high. It should be reasonable. Norm is 1:1. So let's get going. We look for our current assets and we minus the inventory. So it's 1015 minus 564. And straight away, and I go to the answer book, asset test. So 1015, which is my current assets, minus inventory, which is 564, is to current liabilities. So just important, current liabilities, and our current liabilities is 635,200, 635,200, and once I subtract these 1015 minus 564, I get 451,000. 451,000 is to 635,200. 635,200. Now whenever you're doing ratio, the right hand side is always 1. The moment you say the word ratio, calculate, the right hand side is 1. You take the left hand side, divide it by the right hand side, and if I do that quickly, I will get 451,000 divided by 635,200. I get 0.71 is to 1, but always put it in one decimal place. 0.7 is to 1. 0.7 is to 1. So that one is done. And let's just quickly, debt equity ratio, I'll take you again just to show you it is a debt equity ratio falls under our gearing ratios or financial risk ratios. Debt equity is non-current liabilities. It's a shareholders equity. So non-current liabilities, most of the time guys, it's your loan. When you see loan, so it's going to be 8 million is to 8 million. Loans is to shareholders equity. Shareholders equity is made up of retained income, ordinary share capital. Now you can see there's nothing here because in a question earlier in the cash flow, I think they asked him to do those two notes. So it doesn't matter as long as they gave us a total. Fine. I'm going to do videos on this, show you how to calculate, but for now we're just focusing on ratios. And so they did give us the shareholders equity, which is 10,057,50, and so we go straight forward. 10,050,750. when they say ratio, right hand side is 1. I take my 8 million and I will then divide that by 10,050,750. I get 0.795, so 0.80. If I could be more precise, 0.80 is to 1, which is pretty much 0.8 is to 1, and that should be fine. I think that's okay, right? 0.8 is to 1. And then now I must remember, they're not saying comment, they're just saying calculate, so you just calculate. The next one is calculate the percentage return on shareholders equity, which is ROSH, and I'll take you to the formula as well on ROSH. So that's you get an idea of what's going on and how to calculate it. Return on shareholders equity, net profit over average owner's equity. Average owner's equity is the shareholders equity for both the years. You add them up and divide by 2. So I'll show you how it's done. The net profit always after tax, so you need to check for net profit after tax, and they use most of the time they will they'll give it to us. 444,500. So quickly, 444,500. Now I'm going to show you how to get the average shareholders equity. Let me just check again. It is 444,500. Okay, so I'm going to correct that. 444,500. 444,500. If you are having or you need some information, you can email me. You can email me at showeready@gmail.com. Showe, SHER, ready@gmail.com. If you need booklets, you need, let me just correct that. Oh my goodness. showeready@gmail.com. If you need booklets, you need anything related to accounting, especially when it comes to like maybe past papers, you want memos, you want all of that, just email me at this email address and I will be glad to assist you and send you stuff. Also get your friends to subscribe to the videos, because we want to try and help as thousands and thousands of learners across the country during this time. So this is the net profit after tax divided by average shareholders equity, and that's straightforward. Our average shareholders equity is coming from here, the shareholders equity for this year and last year. So I'm going to take these two, add them up and divide by 2. So 10,050,750. 10, and make sure, when there's too many zeros, you can make a mistake. So just take your time, be focused. 9540,000. 9540. And what you'll do is you'll add these two up and then divide by 2. And remember, with this particular ratio, it's a percentage, so don't forget to times it by 100. It's a mistake we can make, so make sure you avoid that. So I'm doing this raw, meaning from scratch, so you get to see where I'm going and don't get confused. So what I will do is when you add these two up and you divide by 2, you end up with an amount of 9795. 375. Right, when you add these two and then equals to divide by 2, and then you times it by 100, and you should end up with a percentage, and I'm going to do that now and check it up. So I'll take 445,100 divided by 9795375 equals to times 100. I get 4.54%. 4.54%, which is also equal to 4.5% if you're rounding up to 1 decimal place. Right, this should be fine. Net asset value per share, and net asset value per share is always the ordinary share capital at the end of the year, so you got to be very, very careful with this, because if we also just take you down there, net asset value, so ordinary shareholders equity at the end of the year. You got to be careful. Ordinary shareholders equity at the end of the year divided by the number of shares in issue at the end of the year. So you've got to get shares at the end of the year and shareholders equity at the end of the year. Both got to be, and you can see I've got it at the end here. So what you will do is let's go and get the ordinary shareholders equity at the end of the year. They did give it to us. It's 10,050,750. So that's going to be 10,050,750. This is now, remember, whenever they say value per share, it's times 100 cents. And so now we need the number of shares at the end of the year. I'm going to show you what to do. Sometimes they may, if you did the ordinary share capital note before this, it'll be easier. But say suppose we're doing this from scratch. You take your shares in issue at the beginning of the year. Shares in issue 900. Now, and then this was repurchase minus the repurchase plus any issued shares. The company issued this. So you take 900,000. This is going to tell us how much of shares are there at the end of the year. Minus 75, anything that has been repurchased, plus anything issued, 125,000. This will give us the number of shares at the end of the year. And if I do that quickly, 900 minus 75 plus 125, I get 950,000 shares. So this is very important. Net asset value is shares in issue at the end of the year, 950,000 shares, and the ordinary shareholders equity at the end of the year as well. When I do this calculation, I take 10,050, 750 divided by 950 equals to times 100. I get 1,057. I'm going to charge that up just now. 1,057.97 cents per share. That's quite massive. So 1,057.9. Effectively, if you want it to be a whole number, it can be 1,058 cents per share. Right, that's that part. We got a couple of minutes, so let's just get going. The liquidity position of the company has improved. Quote, they just say quote, they don't say comment. Quote 3 financial figures. Guys, liquidity, you take asset test, you take current ratio, and you can take debtors collection, you can take stock turnover, you can take creditors payments, whatever, any of the liquidity ratio. So I'm going to go quickly and check my information. And I want to go current ratio. Last year was 0,3, improved to 1.6. So effectively, I will take my current ratio. Guys, last year was 0,3:1. It increased to 1.6. When the current ratio increases and it's within not too high, it's good. So that shows that the liquidity position did improve. I got your current ratio increased from 0,3:1 to 1.6:1. Then I look at my asset test ratio. My asset test was 0,1:1, and I did my calculation earlier. Asset test 0,7:1. So again, there was an improvement, 0,1:1 to 0,7:1. And number 3, I used debtors collection period. Now, last year, it was 43 days, meaning they're taking 43 days to pay us. This year, it's 36 days. Brilliant. Which means that debtors are paying more quicker or faster, more cash, and obviously we're able to pay off our creditors. As a result, paying off debts. Debtors collection decreased from 43 days to 36 days. So that is good. Alright, the last question I want to just have a look at is provide calculation to show the change in dividend payout policy. And then to say explain why the directors decided to change the policy. So watch this carefully. All you got to do here is check your dividend payout per share. Last year was 35 cents and they earned 58. So watch this carefully. So you'll take your EPS divided by DPS. Earnings per, my apologies, it'll be your dividends per share all over what was earned. So your dividends per share divided by your earnings per share percentage. So we are doing now the last year's, which is quickly, I'll do the calculation. So what we do, guys, is you will take your dividends per share. The dividend payout policy is calculated like this. You can see the change. It's your earnings. It's how much we pay a shareholder. Paying is the dividends payout and the earnings per share. So you take your dividends per share for last year was 35 cents out of 58 cents. We earned 58, but we paid out 35 cents, and that's 60.3%. In 2016, we earned 51 cents and we paid out 55. So we paid out more than what we earned. And that came to a percentage. We paid out 107.8%. So you can see the change. It was quite a lot of almost 47%. So the question here now is, why did the directors change the policy? Number one is possibly to satisfy the shareholders, right? To satisfy the shareholders, I'm not spelling it pretty correctly, but because I'm doing it quickly, to satisfy the shareholders due to decrease, and most of the time they will change the dividend payout policy to, it's probably to satisfy the shareholders, because the rush was 6.2% and it decreased to 4.5%. All right. So you can see it was 6.2, we calculated 4.5. All right, all the best.